Welcome back. You're still watching Markets at Noon on ET now. Let's focus in on the macro picture, the big picture for now. We have Prakash Agarwal, the Director and Group Head of Banking, India Ratings and Research, joining us right now to talk a bit about the same. Mr. Agarwal, good afternoon and thanks much for coming on board. Just want to start with the banking space. You have mentioned that banks are yet to tag about 3.5 lakh crore worth of stressed corporates as NPAs. Does this mean more stress for the banks in the next 1 or 2 years?
Yeah, hi. Thanks for the invite. So I guess let me just put the things in perspective. So what we're saying is that of the total bank lending, to the corporates, about 3.5 lakh crore of bank loans are to the corporates whose financials are weak. This doesn't mean that all these will actually slip to NPA. So, at any point of time, you would see that a sizable part, some part of the bank exposure could be some to the weak corporates. In fact, what we are articulating is that the corporate stress for the banking sector has peaked, and the incremental slippages would be more normalized now. So out of this 3.5 lakh crore exposure, which is to the weak entities, let's say about 40% will slip over next 2 years, which means that our slippages about 80 basis point to 100 basis point over next 2 years, which is very normal. I mean, even in normal circumstances, through the cycle basis, you would see that this slippage is occurring unseen. The piece is that if you look at the previous year and the year before, the credit cost of the banking sector was close to 4%, and before that about 2.5%. What we're saying is that incrementally, the slippages, the credit cost of the banking sector would be far lower. In fact, this could be more like what we've seen in a good time. So, on the worst case scenario, the slippages what we are predicting is about 2% for next 2 years, and this is based on the premise that there is no resolution on the NCLT cases, and the bank has to provide for the entire stress cases, whatever is, and all of this slips to a D3 category. So the credit cost would range between 1 to 2% for next 2 years, and the slippages would be more like 100 basis points. So in that case, we think that the credit cost for the banking sector would be far more normalized than what we have seen in the past.
Right. Can you just talk to us about the recent issue which, probably markets have started to note? So when you talk about ADAG group, when you talk about any of the over-leveraged group, suddenly there has been a worry that, what's going to happen over there. But, some of these corporates were already under stress. Why do you think suddenly there is so much talk about most of these groups which are over-leveraged, at least at the promoter level?
Yeah, I guess the 3.5% number which you are talking about actually does include some of the names which you are discussing. So the names like ADAG Group, Reliance Infra and all these names are captured in. And so when we are saying that about 100 basis point slippages would occur, this would actually be part of this. To answer your question in terms of why these are coming, I guess some of these groups were expecting some sort of resolution for quite some time, which has not materialized. The market were expecting that there would be some sort of resolution and the haircuts on this would be somewhat lower than what was expected. But it seems because of various regulatory issues, the pace of resolution has been far slower than what one would have expected. And it seems that there is expectation that the haircuts on this could be more advanced and slightly higher. I guess that's what is playing out. Some of this, that's what is playing out. So that is on the ADAG group, ADAG, the name which you are talking about. And of course, there is I would say uncharted territory on some of the financial sector names. So this 3.5% which we have talked about is ex-financial segment. So we have not factored in some of the stress which we are seeing in the financial sector, some of the large names. In case some of those and those names have become far more prominent in terms of if you see being discussed and the stress being reported, in case the financing becomes challenge for them and if there is a pressure on that could be that could certainly be far more challenging scenario for both the entire FI space, both mutual funds and banks. So I guess this is a space which needs to be washed out, which is which is the financial space where some of the names are being discussed.
Okay. Will this incremental Recognition, is it likely to once again come from public sector banks, or even the private ones could be falling into this category? And what are the segments under stress that you see going forward?
Yeah, I guess, as I said, the recognition has been mostly done. Obviously, in the public sector bank, some of the weaker public sector bank, the credit cost certainly would be higher because the provision coverage, even on the current stressed asset, which is about 10% of NPA, PSV reporting about 13-14%. The provision coverage for some of these names still remains somewhat benign. So incrementally, the slippages while remain more consistent across the banking sector, the credit cost number would be far more higher for the PSB bank, especially the banks which are under PCA right now.
Right. What is the sense that you get when you say that corporate cycle is peaking in? You mean that incremental slippages will get normalized, incremental slippages will return to the levels they were earlier versus, when every quarter you had seen huge slippages from some of the large banking names?
Yes, so that's what we're saying. So, if just to give you a sense, if you see the total stressed assets in the banking sector in the corporate segment has been somewhat stable for the last 4 years. Is the spike in the NPAs? What we're saying is just the recognition of some of the stress which was always existing. It was always there in the bank books, but was not being kind of recognized or not being reflected. I guess that cycle is more or less done. The incremental slippages, what we would see going forward, at least from the large corporate framework, would be a very normalized piece. What we have seen in the past in normal banking framework, we don't see. It's very unlikely that we would see large-scale slippages, large names slipping in the corporate segment, which could have big bang effect on the headline number of the NPA. Having said that, I am repeating what I said, that these are for the non-financial segment piece. There are certain names within the financial domain which are currently under some pressure, which are witnessing some of the pressure. And if there were to be slippages on that segment, that would have a far wider ramification for not only for that name, but for a wider system as such.
Okay, thanks so much on that note for joining us and for helping us understand what is it that's making you believe that the banking sector could be coming up with more stress with respect to NPAs. Moving on then.